So we're going to continue with in-class demo question 5-1. Remember that we had just finished April 18th and we're now moving on to April 20th. Sold inventory to a customer, Gould Inc., on account. Credit terms 110, net 30, shipping terms FOB destination. Well, when you think about this, there are two entries. So let's just cover this on a separate sheet of paper. Wait a minute, I need a separate sheet of paper. Oh, here we go. Let's cover this on a separate sheet of paper. When we sell inventory, two things actually happen. We sell something for a sales price, and then we have the cost of the inventory. Let's just do a quick example of what I mean. Let's assume that we have a very cheap toaster. And the toaster, when we bought it, cost us $10. But when we sell it to our customers, we're going to sell it for $22. Well, you can see that those two amounts don't equal. So therefore, we have to do two sets of entries. We have to do an SSS entry. This is a sales entry to sales revenue for the selling price. That entry has to balance. Then what do we do next? Well, we also have to do what's called a CCC entry. That's the cost entry to the cost of goods sold. I'm not going to use the short form. Cost of goods sold, which is short form. So cost entry to the cost of goods sold for the cost of inventory. So this also has to be a balancing entry. So let's do it. This is now April 20th. What did the company get? And remember, we're doing the SSS entry too, the sales entry to sales revenue for the selling price. So what did the company get? Well, the company got the legal right to collect. Well, the company got the legal right to collect cash from customers. That's an accounts receivable. What's the amount? $6,800. Going to need a new accounts receivable account, and it is $6,800. That's what they got, the legal right to collect cash from a customer. What did they give away? They gave away a product which gave them the right to claim revenue, sales revenue. Why do they have a right to claim sales revenue? Because they did their job, delivered the product. So they have a right. So we're going to go over here. Here's sales revenue, $6,800. So remember SSS, the sales entry to the sales revenue account for the selling price of the inventory. Now I have to do the CCC entry. This is the cost entry to the cost of goods sold. What is the cost of goods sold? The cost of goods sold is an expense account. It recognizes the cost of the inventory that we just used to generate revenue. So that is cost of goods sold. I'm going to use the short form here. It's still on April 20th. Okay, so what did we get? We got the use of the inventory to help us generate revenue. What's the value of this? The value of this is, according to the actual question, the value of this is $4,080. So what did we get? We got the use of the inventory to help us generate revenue. What did we give away? Well, we gave away a bunch of inventory. $4,080 worth of inventory is now gone. So notice you've got two entries. When we are the seller, you've got the SSS and the CCC. Let's move on to the next part of the question. April 21st, the appropriate party paid shipping cost. Who is the appropriate party? We look to the shipping terms. So if we look back on the 20th, the shipping terms said FOB destination. Well, let's go back to the actual terms. Wait, I'm going to grab the sheet. FOB destination says that the shipper is responsible. Who was the shipper? Well, we were. We shipped it out, so we were responsible for it. So looking at this, it says that the fee for shipping it was $100. So what did our company get on April 21st? We got the use of a shipping company to help us generate revenue. And as soon as I say the word use, you know that it's going to be an expense called shipping expense or freight expense, but I'm going to do shipping expense. $100. What did we give away? Well, we gave away cold hard cash because the word paid is in there. So we're going to go back and we're going to deduct $100 from cash. Excellent. Let's move on to the next entry. April 22nd. Some of the inventory sold to Gould Inc. was returned because it was the wrong model. This is the selling price of the returned inventory, $1,000. So as a company, what did we get back? Well, we got back our inventory for $1,000. So $1,000, I almost made a mistake there. That is the shipping. I'm going to correct what I'm saying. Let me step back for a minute. This is the value of the inventory, the selling price of the inventory that was returned. Well, if we look at the original selling entry, we're going to have to reverse this entry. So when we look at it, wait a minute, I've got a highlighter somewhere around here. Where's my highlighter? I know I've got a highlighter somewhere. Just a minute. I can never find anything when I really, really want it. Ah, there we go. So here is the original entry when we sold. And you got to think that was the SSS entry. Now we have to reverse the SSS entry. Why? Because we no longer sold that $1,000 selling price of the inventory. So I have to reverse that portion of the inventory. So what did we get? What did we give away? Well, when you think about it, what actually happened, oh, look at this. I highlighted the wrong one. Goodness sakes. There we go. There's the SSS. This is the CCC. So we've got them both highlighted. Okay. So let's deal with, I'm going to read it again. April 22nd. Some of the inventory sold to Gould was returned because it was the wrong model. This is the selling price of the returned inventory, $1,000. If it's the selling price, we have to reverse. That's what we have to do. We have to reverse the selling entry, the SSS entry, but with one tiny adjustment. So what did the company get? Well, they got a return of the inventory. So they have sales returns and allowances. That's the account name. Sales returns and allowances. So what did the company get? They got a return of their inventory, which is $1,000. Now, is that a positive? Does it increase revenue or decrease revenue? It decreases revenue, so we have to put a negative around it. That's what we got. We got the return of the inventory. What did we give away? Well, we gave back the customer's IOU. The customer had given us an IOU saying that we owe you in the future, but we had to give back the IOU of $1,000, and they no longer owe us that $1,000 at all. I'm going to get rid of this. There we go. That was a mistake. All right. Now we've reversed the SSS entry, just with that slight change to sales returns, but we also have to reverse the CCC entry. So what did the company get on April 22nd? They got back their inventory. And their inventory that they got back, we look at the next line item, April 22nd, the cost of the inventory returned by Gould Inc. is $600. So what did we get back? We got back $600 of inventory, which now has future economic benefit. What did we give away or get rid of? Well, we got rid of the expense, because when we look at the, wait, I just want to make sure I'm on this right line. Yes. When we look at the cost of goods sold, we no longer have an expense because we did not sell that $1,000 of inventory. So this is going to reduce the cost of goods sold by $600. Excellent. Let's keep going. That was April 22nd. Now we're looking at April 23rd. On April 23rd, Sold inventory to another customer, Janison Limited, credit terms 110, net 30, shipping terms FOB shipping point. All right. It says that the sold inventory was $5,600. So what did the company get on April 23rd? They got the legal right to collect cash from their customers in the future. How do I know this? Because there was credit terms. So that's $5,600. Accounts receivable. What did they give away? Well, they gave away a product, which gave them the right to sales revenue. So we go across to sales revenue, and they have a right to claim $5,600. That was the SSS entry. Now we have to move to the CCC entry, the cost entry to the cost of goods sold for the cost of inventory. What was the cost of inventory? The next line item tells us that. The cost of the inventory sold to Janison was $3,360. So what did the company get? What did the company get? They got, what did they get? They got the use of the inventory to help generate revenue, which is an expense account, cost of goods sold. Oh, I forgot to put the April 23rd. Cost of goods sold, we're going to go across to cost of goods sold. What was the cost of goods sold? $3,360, because that's the cost of the inventory that you just sold. What did they give away? They gave away inventory, $3,360 worth of inventory. Excellent. We got the SSS entry and the CCC entry. Let's move on to the 24th. The appropriate party paid shipping terms. April 24th. So what was the shipping terms? Go back to the 23rd, FOB shipping point. So let's go over, let's see. Remember, we are the seller. FOB shipping point, the receiver is responsible, and we're not the receiver. So we don't have to do anything. It's no entry. Let's move on to the next date. April 25th, received payment from Gould Inc. Well, that's April 25th. Excellent. So let's grab a sheet so that we can carefully calculate exactly what's going on the 25th. Remember, we have a 3-step process to do this calculation. So let's do step 1. Let's just make sure that you can see this. Yeah, I'm going to put it up a little higher. Perfect. So step number 1. What is the amount of the accounts receivable? Accounts receivable, because we're the seller this time. So we're going to take the original sale, subtract any returns, and that's going to be equal to the amount of the accounts and that's going to be equal to the amount of the accounts receivable. So what was the original sale? Don't forget, when we're looking at the 25th, the original sale, I'm just going to go to the 25th. This is to Gould. So we've got to go back to the original sale to Gould, which was on April 20th. We sold them $6,800 of inventory. Subtract any returns. So go down and we see, did we return anything? Some of the inventory sold to Gould. On April 22nd, we returned $1,000. So this is actually $5,800. This is the amount of the accounts receivable right now. Let's do step 2. Step 2 is it within the discount period? Can the customer take a discount? Well, let's look. We need first the original date. The original date in this case was April 20th. Then we need the terms. We go back to April 20th and we look at it and it says credit terms were 110. So that was in 10 days. So as long as it's by April 30th. What is today's date? Today is April 25th. So that means, yes, the customer is still within the discount period and they can take the discount. All right, let's do step 3. We want to calculate how much cash. So we're going to take the amount of the accounts receivable, which is $5,800. We're going to multiply it by the 100% minus what percent discount can the customer take? 1%. This is equal to $5,800 multiplied by 99%, and this is equal to, well, got my calculator, $5,800, 99%, that is equal to 5742. This is the amount of cash that we will receive from our customer. Now I've got to look at the discount amount. That is the amount of AR, which is $5,800, minus the amount of cash that we will receive, $5,742. This is the amount of the discount. Wait 1 second. Amount of the discount, $58. So that's the amount of the discount. We've got all the information necessary to record the transaction. Remember, we're on the 25th. What did we get, the company get? We got cold, hard cash. How much? We know from the calculation, $5,742. What did we give away? Because we no longer have a legal right to collect anything from the customer. Accounts receivable. And we know the amount of that from step number 1. The accounts receivable is negative $5,800. But these two amounts don't equal. Where does the discount go? Well, this was a sales discount. Sales discount. So it's got to go in the revenue section. Sales discount. So looking here, sales discount is a total of $58. Is this positive or negative? Does it cause revenue to increase or decrease? And it causes revenue to decrease, so it's a negative number. Let's move on to the last part. May 4th. Receive payment from Jameson Limited. Excellent. Let's do this last calculation here. Step 1. Just want to make sure you can see the sheet. Yeah. Step 1. So step 1, what is the amount of the accounts receivable? So we've got the original sale. So the original sale was on, sold to Jameson. The original sale was $5,600. Subtract any returns. Well, nothing was returned. So that means $5,600 is the amount of the accounts receivable. Then step 2. Are we within the discount period? Well, when was the original date? The date would have been, when I'm looking at this customer, Jameson, it was April 23rd. How many days did they have to pay? 10 days, because their terms were 110. So looking at this, they had 10 days. Terms. So this would be April 33rd. Well, we can't do April 33rd. That's not even real. That's not even a thing. So what's the highest amount we can have? 30 days, half September, April, June, and November. So April only has 30 days. So if I look at the difference between these two, it means it's the 3rd. So the customer has until May 3rd to take the discount. What is today? Today is May 4th. So they're allowed to take the discount? Absolutely not. Do I have to do step number 3? No, I do not. All I need is the amount of the accounts receivable, and I need the fact that they don't get a discount. So how much is the customer going to pay? They're going to pay 100% of the accounts receivable, which is $5,600, because they have no right to the discount. What did the company get? Wait, I'm just going to double check. Yeah. What did the company get? Well, they got cold hard cash of $5,600. What did they give away? They gave the customer back their IOU, and they no longer owe anybody anything. The customer doesn't owe anybody anything. The customer does not owe us anything. We no longer have a legal right to collect cash from them in the future. So that means the $5,600 disappears. Does the equal sign work? Absolutely. Every single entry, the equal sign works. Let's look at what the next required is for this question. And I don't think there is a next required for this question, but let's just double check. Nope, that's it for this question. I'm going to continue with the next question in class demo question 5-2 in the next video. Thanks for watching.